Hi, good morning, everyone, and welcome to this morning's webinar. My name is Bernard Jeter. As you can see, I have my mug posted all over the screen here. And we at Insurance Advisors Direct, pleased to have you with us today to talk about Social Security planning. But before we get started, just like to take care of just a couple of items. Currently everyone on the webinar is muted. But you will be able to answer questions just by typing in your questions, and we'll get to that at the end of the presentation. So also, the webinar will be posted on our YouTube page, generally in about 48, 72 hours. And I'm also going to send everyone a copy of the webinar so you can have it on your files for personal reference. All right, so webinar is being recorded, as we stated. And as you can see, here's my contact information. Office number is 248-946-4640, extension 112. So, who is Insurance Advisors Direct? And like I said, what we like to do, we're for a service FMO whose mission is to simplify your success, and as you see through our 7 pillars of success. One that I pride ourselves on is our sales tools, and this webinar is actually one of our sales tools in learning Social Security planning. So with further ado, we're going to introduce Will Torrance, as financial advisor for over 12 years with expertise in Social Security planning. So with that, Will, my friend, go ahead and take the reins.
All right. Well, thanks for the introduction, Bernie, and I appreciate everyone taking the time today to attend a topic that I believe is particularly pertinent, because the interesting thing is that over 10,000 individuals are retiring in this country every day. So if you take into account just that individual statistic, this topic is something that is always on top of mind when you're out there speaking to clients that are in their late 50s or even their early 60s. Social Security is something that is a right that everyone pays into the system for a number of years, and it's highly complicated. A number of the pieces of information I'm going to go over today are probably going to confuse you if you don't have a whole lot of experience with them, but the reason that I put the confusing topics in there is to basically reiterate to everyone on the call today that it is a complicated process that really overwhelms individual clients, but it doesn't have to be overwhelming. It's actually something that can be very simple, and there's some strategies that you can employ that would really hold you out as a trusted individual when it comes down to when a client is finally considering taking their Social Security benefits. So with further ado, I'm going to get started. So we're going to go over planning strategies and terms on Social Security today. So like I said, some of the information that I'm going to provide might seem a little bit over the top or a little bit confusing, but the reason why I wanted to put this information into the presentation is to show you why so many individuals out there are unaware of what actually is the proper way to take their Social Security and then the planning strategies that are employed with this. So we're going to go over Social Security in general, maximization strategies, and then what I call future expectations of the Social Security Administration. I'm sure a lot of you out there have either read or heard about that the Social Security safety net will run out by 2034 or 2035. I'm here to tell you that, unfortunately, government will not allow that to happen, and there's a lot of levers that they can pull in order to make this a sustainable option for future retirees. So just some background. You can see here that it was passed as the Social Security Act in 1935. It was created under FDR, and the goal was to provide basically a comprehensive package of benefits for individuals should they need them in the near future. So basically what we understand them to be is a monthly income stream for the rest of their life. So what is Social Security? It's basically an insurance policy in its barest forms to provide certain individuals if they're unable to work and they've paid into the system for a number of years. And then you can also see there's old age, disability, and death to provide to other beneficiaries as well. So this is just some interesting statistical analysis. As I had mentioned at the outset of the presentation, 10,000 individuals are retiring every day and are able to then potentially claim their Social Security. Currently, we have 65 million individuals that are actually receiving benefits. And 9 out of 10 of these individuals age 65 and older receive benefits. So, I mean, I just want to let that kind of sink in for you. Those numbers are pretty high. And that 9 out of 10 area is something that is pretty telling. That 9 out of every 10 individual in this country is receiving benefits to some degree. I'll get into some other details with respect to why that's such an important thing to consider when you're doing Social Security planning. Because the next stat is something that's even more telling. 33% of the income received by the elderly, and among the elderly, 50% of married couples and 70% of unmarried, 50% of their income is received from Social Security. So there, again, that's kind of a scary statistic if you think about it. If an individual is relying on 50% of their income to come from Social Security, that to me is a very telling statistic and is something that we as insurance and financial individuals need to be aware of and very cognizant of, that these individuals need some assistance either prior to taking their Social Security benefits or while they are currently taking them. So 21% of the elderly married couples and about 45% of unmarried, 90% of their income is derived from Social Security. So I think about it from a standard of living perspective. If you think about it from that perspective, then ultimately they are completely relying on Social Security for their living. And just to correlate this to the Medicare side of the fence, a majority of their Social Security benefits are going to pay for health care. The last one is kind of an interesting one. Currently, 178 million workers are covered under Social Security. These are previous years. They'll have 2020 statistics out next year. And I just wanted to reiterate, I'm sorry I didn't say this in the beginning. If you have any questions, please put them into the chat box, and I will try to get to them during the presentation. But there will be time at the end of the presentation to answer any questions that might arise during the presentation. So we're going to continue with the statistics and facts. 49% of the workforce has no private pension coverage. So basically, half of this nation that are retirees or are going to retire in the future have no safety net. So I think that this is another important thing to consider, is that we as financial and insurance individuals need to realize that the majority half of this nation has not done the proper planning with respect to providing for their retirement years. They potentially could rely solely on Social Security for their living expenses in the future, but that does not mean that it doesn't give us an opportunity to present planning opportunities to them to assist them for their retirement years. Now, I saw a question come up real quick. Danny asked, 178 million covered the same as receiving Social Security. I'm not really sure what you're referencing, Danny. I was saying that 178 million people are currently paying into the Social Security Administration, not taking benefits. I hope that answers your question. So, okay, perfect. So by 2035, the number of Americans 65 and older will increase from 56 million to 78 million. The reason I put that statistic in there is because it's going to ultimately mean that more individuals are going to be taking benefits by 2035. What that's going to do is it's going to put stress on the actual Social Security benefits that will be paid out because of that increase. And this next statistic is the reason why. Because currently we have 2.8 workers paying into Social Security. By 2035, there's only going to be 2.3. So the lessening of actual workers paying into the Social Security Administration potentially means that the benefits will run out. That's why that 2035 date that I referenced in the beginning is such an important one. So, I wanted to go over qualifications just in case you weren't aware of them, because there are certain qualifications that you must meet in order to be eligible to receive Social Security benefits. Okay, hold on one second. I'm going to pause for a second. There's another question before I get into this. Danny, I can give you that specific number. As Danny asked, do you know what it was at the start as far as workers per beneficiaries? You mean in 1935 when this first started? I don't have the specific number in 1935, but there were significantly more individuals that were paying into the system than actually taking benefits, and here's the reason why. If you take a look at 1935, and this isn't me saying this is just society the way that it was back in 1935, the preponderance of individuals that were working and paying into the Social Security Administration were men. The men were out there working full-time. The woman was at home taking care of the children. Now, obviously, when World War II hit, a lot of women were employed in the war factories, so there was a potential that a woman could end up paying into the administration. But I think it might have been, Danny, like a 6-to-1 ratio. Hopefully that... I'll give you the specific number. It really actually, that number in 1935 does not really equate to what we're focused on today. That number of 2.3 in the future is the number that we really need to be aware of, and I'll go into a little bit more of the factors of what government will do to try and sustain the benefits for the future for individuals that are paying into the administration. So basically, to get into the minimum requirements with respect to qualification for Social Security benefits, you have to work a minimum of 10 years, and they calculate the highest 35 years of earnings. Now, there's a minimum amount of money that you actually have to earn, and it is done on a quarterly basis. If you wanted more specifics on that, I can always go into them with you. But what I did here, this is the confusing part that I referenced in the beginning of the presentation, but I think it's important for you from an understanding standpoint to understand how the actual benefits are calculated. So, I'm not going to go into too much. I just wanted for you all to have the benefit of being able to see what this is. This is what's called adjusted index monthly earnings. So what they're going to do is they're going to compute an insured worker's benefits based on his or her earnings and the change in the general wage levels that occurred during the worker's time of actual employment. The indexation ensures that a worker's future benefits reflect the general rise in the standard of living that occurred during their employment years, and up to 35 years of earnings are needed to compare for this adjusted indexed monthly earnings amount. So you take the sum of indexed earnings, divide the total amount by the total number of months in those years, then round the resulting average amount down to the next lower dollar amount. The reason I read that verbatim is because if you're thinking in the back of your mind, wow, this sounds like a very complicated calculation, it is. But I'm here to tell you that ultimately you don't really need to know this from a perspective of being assistance to a client. I'm putting this in here to show you why so many individuals that are applying for Social Security are unaware of the actual provisions and the calculations. So, based on this adjusted index monthly earnings amount, you become eligible to receive retirement benefits at age 62. So if we're talking about the current year, so this year, 2020, is the first year that you become eligible, we would divide the national average wage index for 2018. They're going to take a 2-year look back, and that's the actual number that they're using for individuals that would be collecting for this year. So they divide it by the national average wage index for each year prior to 2018 in which the worker had earnings and multiply each such ratio by the worker's earnings. What this then ultimately calculates is the index earnings for each year prior to 2018, and then they consider any earnings in or after 2018 at base value, so no indexing with respect to that. So then the AIME is computed and use this amount in computing the worker's primary insurance amount. Now I'm going to stress this. The PIA is the only real number that you need to make a client aware of. And the interesting thing is you can actually, any of you on the call right now, could go to the Social Security Administration, and if you've had income paid into the system, you could find out what your estimated PIA is today just by creating a Social Security username, password on SSA.gov. So this adjusted index monthly earnings, like I said, this was more background information than anything else. You don't really need to know this, but I wanted to provide you the calculation in case you're like me and kind of a nerd and likes numbers. So here's what I was just stressing. The primary insurance amount is the important number that we need to know when we're talking to a client about their Social Security benefits for the future. So it's the sum of 3 separate percentage portions of that AIME that we just went over. So the dollar amounts in the formula change annually with changes in the National Average Wage Index. The dollar amounts are called bend points, and they govern the portions of that actual AIME. The current bend points are $960 and $5,875, which would then apply for any individual worker that's eligible to start taking benefits here in 2020. So I give you an example. So a person with maximum taxable earnings each year since age 22. This is just a generic example. So they've worked for 40 years and they retired age 62 in 2020. Their AIME is $10,683. So we take this AIME amount and the bend points currently for 2020 of $960 and $5,785. This is now calculating our primary insurance amount, which would be $3,142.70. But here's the problem. The PIA that is listed on the Social Security website, and this number here of $3,142.70, is not what they would receive at age 62. That's why many individual clients are confused when they go on and they register on the Social Security Administration website. They see that PIA listed on there, and then they realize that at age 62, that's not actually what they're going to be receiving. The last point there, or last bullet, the cost of living adjustment this individual will receive is the one effective at the end of this year. So going back into that example of what I was referencing, the monthly retirement benefits are derived from the PIA. They may be higher or lower than the PIA that's actually listed on the Social Security Administration website. So that's what I was referencing with respect to the previous slide. So I'll just go back to that so you can see that right down here. So reduced benefits are paid to one who retires before his or her what's called normal retirement age or full retirement age. I'll go into that in a little bit more detail here in a couple minutes. So A person cannot collect retirement benefits before age 62. So if you retired at exactly 62 in this year, your benefit is automatically reduced by 25% less than that PIA amount. So as we calculated previously, that individual that had 40 years of earnings had a PIA amount of $3,142.70 on the Social Security Administration website. The 25% reduction, if they started taking benefits at 62, would reduce the monthly benefit to $2,357.04 for the rest of their life in their monthly benefit. So, it's a personal decision on whether or not a client wants to take their benefits at age 62. But here is the key point that most individuals don't realize. If you start taking your benefits at 62, you have an immediate reduction of 25% for the rest of your life on your monthly benefits. Many individuals out there don't know this. It's our job to make sure that they're aware. So the final point on this slide is that benefits can be higher or lower than the PIA if one retires after normal or full retirement age, and the credit given for delayed retirement credits will increase 8% a year for those born after 1942. I'm going to go into that in more detail later on in the presentation. I'm going to pause for a second and see if there are any questions. Okay, I don't see any additional at this point, so I'll just continue. Please feel free to continue to put in questions in the chat box, and I'll reference back to them every couple of minutes. So, I wanted to go into some estimates here after we have determined where that primary insurance amount comes from. And like I had referenced, the Social Security Administration has that PIA amount on once you create a username and password on the SSA.gov website. So those estimates are in present value, that PIA amount. They have not been adjusted for cost of living adjustments, which is obviously inflation for potential benefits in the future. And these estimates may differ because earnings may have increased or decreased, potential COLA adjustments, and estimated benefits are based on current law. Those are just some kind of Social Security Administration pieces of information. So really what I wanted to do is, this is really an important slide here. And like Bernie had mentioned, you're going to be able to access the presentation here in the future. But if nothing else, this chart right here is one that I feel is incredibly important. The reason why I say it's incredibly important is that it gives you a gauge here on an individual client's birth years on when their full retirement age is. Now, if you remember back a couple of slides, I was referencing that if an individual takes their benefits at 62, they're going to have an automatic 25% reduction. If they reach these thresholds of full retirement age, they will receive 100% of their PIA, which is listed on the SSA.gov website. So these would ultimately give you a good discussion point to have with a client to basically inform them of when their full retirement age is, and thus being able to realize and collect 100% of their Social Security benefits. So this is just a representation of what could potentially happen if they took at age 62, if they took at age 65, if they took at age 66, or took at age 70, their benefits. So you saw, and as I had referenced previously, at 62, there's an automatic 25% reduction. These are the current max beginning monthly benefit amounts. These are just examples. They kind of do a general consensus of the average for individuals that are collecting Social Security benefits. So at 62, the average monthly would be $2,265 at 62, at 65, and then up to age 70. And as I want to reference here, for the age 70, Every year that you wait past full retirement age for an individual that's born between 1943 and 1954, you will receive an 8% increase in your monthly benefits to the current average max of $3,790. Pause one more second, check the question box. Okay. Okay, so I'm going to go into some of the areas where the contributions come that ultimately Social Security beneficiaries will be able to realize from their benefits. So the majority of it comes from FICA. As everyone probably well knows, if you were employed by a company, you're employed by a company now, they take out FICA taxes from your paycheck. That is specifically there to be funding the Social Security Administration for beneficiaries that are collecting benefits in the future. So wages are subject to tax up to a certain earnings level called the taxable maximum. That current max amount is $137,700 for the current year. So the workers pay 6.2%, the employer pays 6.2%, that total is 12.4%. Now, I referenced this because a lot of us as insurance and financial professionals, we potentially, if it's the way that we're working, we are paying that full 12.4% ourselves. There's also a 1.45% tax for Medicare, and these taxes make up 83% of the revenue that Social Security ultimately will end up paying out to their beneficiaries in the future. So there have been some amendments since 1983 because Social Security actually was running surpluses, allowing their funds on hand when the worker per beneficiary ratio declined. So I had referenced previously a number of slides ago that by 2035, the actual worker to beneficiary ratio will be 2.3. That's why a surplus in the Social Security Administration is so important, is that as the worker to beneficiary ratio is going down, the potential amount of funds in the actual account to pay to beneficiaries additionally goes down. So if they do have a surplus, it accumulates over time and are held as bonds in a treasury account. The interest from the bonds is the second source of revenue for the Social Security beneficiary program, but it only counts for about 14% of the revenue. Some also contributions come from tax on higher income beneficiaries, and if you're working while receiving benefits, there are also taxes that could potentially come out. So, continuing on with the contributions section, you could pay tax on only 85% of your Social Security benefits based on IRS rules if this. Now, these are important areas to consider. These are the income thresholds where you could potentially be taxed on your Social Security benefits. So if you're an individual and the income is between $25,000 and $34,000, you may, not necessarily will, have to pay income tax on up to 50% of your benefit. If you earn more than $34,000, potentially up to 85% of your benefit may be taxed. If you file a joint return and you and your spouse earn between $32,000 and $44,000, you may have 50% tax, and more than $44,000, potentially up to 85% of your benefit may be taxed. Most people will not do the final provision married file separately, but I just wanted to provide it there for informational purposes. So basically, hold on, I'm going to stop real quick. Cheryl had a question or a statement. Some states don't charge tax on your Social Security if you're older or at your required age. Yes, that is correct. Basically, you're only going to be taxed on your Social Security benefits if you claim at age 62 and through your full retirement age. So it's important to note that if you have a client that is dead set on taking their benefits at age 62, those income thresholds that I just referenced are going to incur a tax on their Social Security benefits from age 62 until their full retirement age. The actual maximum amount of income that you can have, that I didn't put in here, but it's important to note for 2020, the maximum amount of income that you can earn without having taxes on your Social Security benefit while you're receiving them is $18,240. So if you start taking your benefits at age 62 and you earn more than $18,240, you will be taxed on your Social Security benefits until you reach full retirement age. After full retirement age, the income limits do not apply. But for 4 years or 4 years and up to 10 months, you could be paying taxes on your Social Security benefits, which would then erode that possibility. You're already having a 25% reduction at age 62, but then you have a potential other tax coming out of that limited benefit as well. So this is just a okay, Cheryl had another question. Now it's the income is applying to an individual that is collecting Social Security benefits, Cheryl. So if you are collecting Social Security benefits and you're earning income that's above that $18,240 currently for 2020, that's when you will incur the tax on your Social Security benefits. Once you reach full retirement age, that's when this bogey, so to speak, will go away. But they will tax you for basically for the 4 years or 4 years and up to 10 months. Does that answer your question? Okay. So combined income consists of your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits. So that's giving us what the income is. So basically what I wanted to do here is I wanted to give you some considerations and some questions that you should be asking your clients probably in their late 50s because they will become eligible at age 62. So we want to know, what are their essential retirement goals? Do they have any other sources of retirement funds or potential income that they could use that's going to ultimately benefit them in the future? Are you married? Obviously, that's important. Life expectancy. Now, this is obviously something that we can't codify down specifically, but a Fidelity Investment study as well as the Social Security Administration has gauged that an average for a male age 65, they're going to live 20 years in retirement, and a female 22 years in retirement. So life expectancy during retirement has gone up. So ultimately what we need to do as individual advisors is inform a client first what their PIA amount is, their monthly benefit, and is that enough for them to live and pay for their expenses? And it's really important for us to identify additional assets that we can incorporate into financial vehicles to create what I call a parallel income stream in addition to their Social Security. Because most people, as you can see from the very first example, $3,142 a month if you've reached your full retirement age may not be enough for you to live in retirement unless you have saved additional assets. So the other consideration is, are you eligible to file on an ex-spouse record? So I'm going to go into a couple of different things here that most individual Social Security beneficiaries are unaware of, and this could potentially set you apart in discussions that you're having with clients that are approaching that age 62 or are considering their Social Security benefits for the future. So I'm going to start with the spousal benefit, which a lot of individuals are not aware of. It's one way you can collect benefits is on your spousal's record. So there are some requirements that have to be met in order to be able to do this. Your spouse has to be of full retirement age, and if you, as the other spouse, I know that that's kind of a double negative, but I'm sorry, it's hard to codify that into an easier way to describe it, but it's considered filing if you take them early. So basically the way that it works, it doesn't matter if it's a male or a female, the higher earner has to have filed. And the maximum spousal benefits are 50%, and they're reduced if you take them early. So at age 62, for example, if you start taking your spousal benefit from the higher wage earner who has filed and is at full retirement age, you are going to get a reduction in that amount. But I'm going to go into a reason why that might not necessarily be a bad thing. And the spousal benefit has to be higher than your own PIA. So what I'm saying there is that, let's just use an example. Mary and John are married, and John was the higher wage earner, and he is 66, and Mary is 62. So he's filed, and she's considering taking the spousal benefit. The spousal benefit, which would be half of John's PIA, has to be higher than Mary's PIA in order for her to receive it. And the reason why that's so key is that if she wanted to start taking it at age 62 in this example, she could, and we'll just say that John's amount, his PIA monthly amount is $3,000. She could be collecting $1,500 a month on John's PIA, and if she had worked and earned enough credits to have her own Social Security benefit, then that $1,500 would be paid to her, and then she could let her own benefit grow until she reaches full retirement age, and then if her PIA goes above the spousal benefit, she would flip to her own benefit. And I'll go into a little bit more of an example here. So these are the requirements for an ex-spouse to claim on, so if you're divorced. So there's 4 requirements. You had to have been married for at least 10 years. You had to have been divorced from the ex-spouse for more than 2 years. You and your ex-spouse have to be at least 62 years of age. And generally, the lower earning spouse cannot be remarried or eligible for equal or higher benefits. So the benefit is, as a divorced spouse, is equal to 50% of your ex-spouse's primary insurance amount. So like I had referenced previously with John and Mary, if he's 66 and he's filed and she's 62, he has a $3,000 monthly PIA. She can collect $1,500. That's where that 50%. Now, granted, I should make this point too. If she takes it at 62, she's not going to get exactly $1,500 because there's a reduction for her to take it at age 62. If she reaches full retirement age, then she would get the full $1,500. But I'll tell you right now, if you are an ex-spouse and you're divorced and you meet all of, let me go back. If you meet all of these criteria, it might be more beneficial for you, even if you're just 62, to take this benefit for the 4 years or 4 years and 10 months or subsequent months and get that money from your ex-spouse and let your primary insurance amount get to 100%, and then hopefully it is higher than your spousal benefit when you start taking benefits. Okay, Cheryl just asked, if he dies, can she still receive his full benefit? Yeah, here's survivor benefits, so I'm going to go into that right now, Cheryl. So, as a surviving spouse, you are entitled to benefits. You can get them as early as age 60, but they're reduced by 28.5%. And here's, Cheryl, where you would see this. You're eligible to collect 100% of the higher earning deceased spouse's benefit if the survivor is of full retirement age. There's always going to be reductions in the PIA amount that you're going to receive if you're not of full retirement age. But that's not necessarily a bad thing, because technically any time that you're able to receive this benefit is better than receiving no benefit at all. So obviously the ultimate goal is to try and reach full retirement age in order to realize the maximum or 100% benefit for these provisions with Social Security. So an ex-spouse record, a survivor spouse record. But ultimately the way that I look at it is that if a surviving spouse can collect something from Social Security in addition to any other money that comes in, it is going to provide that safety net for them. So it's a personal decision on how you decide to do this, on whether or not you want to wait till full retirement age. Now, with someone that passes away, we can't plan for that, but ultimately with claiming on an ex-spouse's record, it's always been my goal to get them collecting that money as early as possible, even if it's a reduction, because they didn't even realize that they were eligible to receive it in the first place. So I'll pause and see if there's any questions. Okay, I think we're doing all right so far. So here's just a continuation of the survivor benefits provisions. So your widow or widower can receive benefits at any age if he or she takes care of a child who is receiving Social Security benefits and younger than age 16 and disabled. So that basically what that means is that age 60, which I referenced previously, I'll just go back. So you can see you can receive survivor benefits as early as age 60. Here's a couple of other provisions that override that. If your unmarried children who are younger than age 18 or up to age 19, if they're attending secondary school full-time, they can also receive benefits. And then children can get benefits at any age if they were disabled before age 22. And then your dependent parents can receive benefits if they are age 62 or older. Okay, let me pause 1 second. Christy has a question. I'll just read this for the benefit of the attendees. If you collect the spousal benefit before full retirement age, are you still limited in your earnings just as if you had taken your benefits early? No. The spousal benefit does not count. Basically, the way that the benefit works is if you are taking your benefit. So if you are taking your own PIA, that will limit you in the earnings that you can make before being taxed on your own benefits. So that $18,240 that I referenced is the maximum income for 2020 that you can take or that you can actually earn before your benefits are taxed. If you're taking the spousal benefit, that is not your own benefit, so you're not technically going to be taxed on the spousal benefit while you are still earning. And I'll make sure to confirm that. That's a very good question, Christy, but I'm pretty certain with respect to if you're receiving a spousal benefit and you're not receiving your own, that you would not be taxed and you would not be limited in the amount of income that you can actually earn. So, I wanted to go into some individual claiming strategies here at different age and reasons why you would do these certain claimings. So, scenario one would be taking it when you're first eligible at age 62. So the pros of that are you receive payments early and beneficial if you have a low life expectancy. So you're just going to try and get the money that you've paid taxes in for the minimum of 10 years, maybe maximum of 35 years. You want to get the money because you might not live very long and you want to try and get all the tax dollars that you've paid in out of the pool. Obviously, it's the smallest monthly check. Smallest survivor benefits if you have a spouse that passes away, and potential reduction penalty for employment. Like I had mentioned, that $18,240, you're going to get taxed on your benefits if you earn income above that amount, and it's also going to be taxed on a lower amount because, as we remember, you automatically get a 25% reduction if you start taking at age 62. Okay. Danny asked a question. I'm just going to reference this for the whole attendees. Are your Social Security benefits subject to taxes if taken at full retirement age? No. If you take them at full retirement age, you're not going to be taxed on them. Cheryl says, I was told that taking my own benefit at age 66 and waiting to take my spousal benefit when my spouse retired and started his benefit at age 70 to get a higher spousal benefit. Potentially, Cheryl. Not necessarily. That's why I wanted to go into these individual claiming strategies at different ages, because ultimately the best option is to wait till full retirement age because of the potential taxable issues on the additional income you make, also the reduction for life that you have if you take it at age 62, and also the potential for the spousal and survivor benefits reduction. So the ultimate goal is to reach your full retirement age. And let me pause. I have another question here. So you can be taxed for the months prior to full retirement age for employment over the limit example. Full retirement age is in December, so you'll be taxed for earnings January through November. Correct, Christy. All right. I'm just going to continue with this slide real quick. So obviously, as I was referencing with respect to full retirement age, it's a higher monthly check. You're getting 100% of your benefit. Higher survivor benefits, 100% of the survivor benefits, and no penalty for employment. So any time that you're earning income after your full retirement age, your Social Security benefits will not be taxed. So you're not having to adhere to that $18,240 income threshold. Like I said previously, though, this is a highly personal decision for many individual clients to make. All of this information that I'm giving to you right now, I would say at least, and it's probably higher, at least 75% of the individuals that are applying for Social Security at age 62 have no idea about all of this that we're going over. And interestingly enough, the Social Security Administration is not allowed to give advice. It's actually in their handbook. They are legally against or legally prevented from giving advice to a Social Security beneficiary. One last question. Danny asked, do some states tax the Social Security benefits? It depends on the state. Is there potential possibility that your Social Security benefits could be taxed in a given state? Yes, but I don't know all of the state provisions, Danny. So there is a potential. I'm not saying it's a guarantee, but educating yourself on your specific state Social Security benefit potential from a taxation perspective would be something that you want to be aware of. And then getting back to the slide here, basically the ultimate is if you can wait till age 70, you get those 8% additional credits. So obviously that's the highest monthly check that you can get, highest survivor benefits, and then still there's no penalty for employment. And obviously the cons are you receive benefits later. So I wanted to go over those were some claiming strategies, the pros and cons. I wanted to go over what I called some break-even points here. So once again, I want to reiterate that taking Social Security at age 62 and any age is a personal decision. We just need to be there to inform them on reasons why it may or may not be the most beneficial for them. So it comes down to a personal choice, but being informed is obviously the most beneficial thing that a client can have. And we are now armed with some more information from this presentation that we can inform individuals that might be unaware. So if you look at age 62 when you're first eligible for Social Security versus just a general full retirement age of 66, The break-even point for you, in order to receive benefits, you have to live to at least age 77 or 78 for your benefits to equate to when you start taking them at full retirement age. Now, I'm not even applying the potential tax that you might incur between age 62 and 66 if you earn income above that. So there are some other negatives about taking it at 62. These are just general break-even points, not taking into account any other additional income or taxes. And then at age 62 versus age 70, you actually have to live to age 80 or 81 to receive the same level of benefits that you would start taking at age 70. And then once again, full retirement age 66 versus 70, the break-even point is 83 and 84. But here's the problem. We don't have a crystal ball on life expectancy and potential catastrophe. So we just need to inform a client about the possible pitfalls of taking it at age 62 and the opportunities that are available if they have longevity in their family or other certain things where they can continue to work. These are just pieces of information that we need to make clients aware of so that they are truly maximizing their benefits. So if they need money now, they take it now. If they don't need money now, then they don't take it, because we're giving them the information on reasons why it may not be so beneficial for them to take it right at 62 when they are first eligible. Okay, so I wanted to go over a couple of examples here for an individual that would be claiming Social Security when they are a single individual. I wanted to use, okay, hold on, let me pause before I start into this. So Cheryl asked a question, doesn't Social Security still have a couple household cap at approximately $4,400, and has that increased in the past 10 years? Are you talking about the monthly benefit, Cheryl, with respect to a couple and the amount that they can receive? Okay. Yeah, I have to confirm that number of $4,400, but I think you are correct. Okay, so I just wanted to go into a specific example here of claiming Social Security for an individual female. So an individual female with an average life expectancy, it could be, might not necessarily be, but it could be the best strategy for them to claim Social Security as late as possible or until age 70. That would then ultimately, from her full retirement age until age 70, she's getting the additional 8% credits. For a single male with an average life expectancy, it could be most beneficial to claim at age 68. Now, granted, these are general rules. This does not apply to everybody. This is just kind of a generic example that I wanted to give you so that you could have some ideas of when you're discussing with a single male or a single female, the potential most beneficial strategies. So if we look at an example here, Mary's age 62. If you claim benefits at 62, her monthly benefit is $1,500 for life. At age 66, it's $2,000, and if she waits to age 70, that's $2,640. Now, those are just generic examples. That has nothing to do with the earnings and the examples that I gave when we started the presentation. I just wanted to give you an example of what the potential monthly benefit change would be at 62 full retirement age and age 70. So, another example, going into the spousal benefits and then collecting your own. So, higher earners, you collect individual benefits from full retirement age onward. So, this would be a higher earner individual that would then collect the spousal benefit from their full retirement age onward. So, technically what I'm saying there is that it's most beneficial for them to wait until their full retirement age and collect that spousal benefit into perpetuity or until they pass away. Lower earner, you start at full retirement age and collect spousal benefits until age 70. And at age 70, the lower earner switches to his or her own benefit if it ends up being larger than the spousal benefit. That's almost an automatic that happens with the Social Security Administration, but it's not definitively automatic. So this is obviously, like I said, just 3 examples. There are potentially, you know, obviously I know this is probably extreme, but it could be hundreds different because everybody is in a different scenario. So that's why I wanted to stress here that it's an individualized case. You need to address the issues with each individual separately and make sure that we provide the information so that they know exactly which claiming strategy is going to be the most beneficial for them. So here's a spousal benefit example. So strategy 1, Kelly is divorced. She's age 66. She claims now at her age 66, her monthly benefits are $2,000. That's her PIA. Or strategy 2, claim first the spousal benefits from age 66 to age 70, which is $1,000, and then claim later her own benefits when she turns 70, which would be $2,640. So basically what I'm saying there is that she takes the spousal benefit, she's lucky enough to be at full retirement age, she gets it for 4 years, and strategy 2, is a 32% increase in monthly benefits and a 15% increase in her lifetime benefits. Like I said, a lot of these examples that I'm giving you is just for reference purposes only. If you have individual cases that you're working on in the future, I would definitely encourage you to reach out to Bernie, or if he's making my services available to you, then you can always reach out to me specifically as well. So I wanted to conclude with this, just so that you are able to make your clients aware that Social Security is a right as long as you reach the minimum requirements of the 10 years or the quarterly credits. I won't give you the exact amounts, but they're pretty low as far as how much money you need to earn quarterly in order to be eligible for benefits. If you're earning only the minimum quarterly amounts, you could end up potentially having to work more than 10 years. Before I get to the rest of the conclusions, I have another question. Would that chart be the same for a deceased spouse instead of a divorced spouse? Let me go back. Is this the chart that you're referencing, Danny? Okay. Yes. The difference in this would be if it's a deceased spouse, you're actually at full retirement age collecting 100% of the higher earner's benefit. Does that answer your question? Okay, perfect. Okay, so just getting back to the conclusions once again, Social Security is a right. We need to make sure that we are informing individuals, especially individuals that have never paid into the system, so a spouse of a higher earner, be it a man or a woman, that they can collect those spousal benefits. That is of utmost importance. I can't tell you how many times I've had individual agents call me and they've run into this scenario where an individual was completely unaware that they could collect spousal benefits even if they've never paid into the Social Security Administration. That, if nothing else, if you derive any other value from this presentation other than that, that is one that is of utmost importance, and the survivor benefit as well. Most individuals out there, like I had referenced, 75% of individuals, most likely many, many more than that, have no idea that these benefits are warranted to them or that they can actually collect. So many considerations must be made before claiming the benefits, and actually when. So that it's our job to make sure that we provide the information to them so that they're aware of this individual opportunities. And basically, the third point here, advice by the many is needed to make the right choice. Like I've already referenced it a couple of times here. Many people are unaware. It's our job to make sure that they are aware. And you can be the trusted advisor for their needs. And this last point is that we are partnered with Bernie and IAD, and ultimately, like I said, if he's going to make my services available to you, which I think they will, I am going to be here to assist you with any type of needs that you have. I've been doing Social Security planning probably for the last 12 to 15 years, and there's some individual strategies that I can discuss with you individually to help put together what I call bridging strategies with the use of annuities that can get individuals from age 62 to full retirement age, and thus creating a parallel income stream in addition to their Social Security benefits. Basically, what we do is we reposition assets from something that might be in the bank that's underperforming, or if they have any type of investments, we transition them over and we create a parallel income stream, thus benefiting them in two ways, in their Social Security and a guaranteed lifetime income as well. So that's me, or actually, Bernie's up there and then me. I'm glad you didn't get to see me on my webcam. It wasn't working. I look like Grizzly Adams right now because of the virus. I have a big beard, and my hair's a little bit longer, actually quite a bit longer than that. But definitely wanted you to see that we're going to be available. And then here's a bonus piece that I had mentioned that I was going when Bernie and I spoke earlier. I wanted to mention this. I understand that a number of you out there are currently working in the Medicare side of the world, and me being a financial planner, I was very ignorant or unaware of some very important planning provisions that can come into play with respect to clients and their Medicare. So I'll ask the question of individuals and just reply if you know what I'm talking about. If you have ever experienced an IRMA issue with any of your Medicare clients, I'm going to give you guys a chance to respond. Okay. Danny says he has not. If you've already checked out of the presentation, that's all right. Basically, the reason I wanted to bring up IRMA is that I became aware of it probably about a month ago. What it is it's based on modified adjusted gross income for a client, and there's a potential that they could incur a surcharge on their Medicare Part B and D premiums if they fit outside certain income thresholds. There's 3 specific strategies that you can employ to help assist a client so that they don't incur this surcharge. And I just wanted to make you aware that that is something that I can assist you with moving forward if you have any individuals that could potentially incur this surcharge. And I don't see any other questions, so Bernie, I think I'm going to wrap it up. And I appreciate everyone taking the time today. I hope it was useful for everybody, and appreciate any questions that you might have in the near future. So take it away, Bernie.
All right, Will. Well, thank you very much, my friend. I don't know about everyone else, but I really enjoyed this presentation. A lot to learn. Actually, I've learned a lot from this presentation and just researching on Social Security. So what we're going to do, I think we just had one more question, just a quick one here. If I can see it. I think that came from Dale. And no, Dale didn't have a question. But Dale, thank you, my friend, and you're welcome, sir. So with that said, no, we actually a very good partnership with Will. So if you do have any questions or you have cases relating to Social Security planning, by all means, reach out to Will. Then Will and I, and here's his contact information again. Will and I will get together and come up with a strategy for you, get that product going for you. So like I say, at the end of the day, it's all about your client. It's all about the knowledge that we have and the usefulness that we have to give to your clients. So reach out to him or myself. We'll get together on it, come up with the best solution, and get it to you so you can get it out to your client. So I hate to rush. We have another webinar going at 12 o'clock, which I hope most of you will be joining. Jason is doing his second part to marketing. If you saw the first one, very good presentation. The second will also help you with your marketing needs. Then the other upcoming event that we have is our AHIP planning. So you should have received an email for that. Look that over, sign up for that, and the folks here will be willing to assist you with your AHIP training. And again, folks, everyone, you have a great day, a great weekend. Sure, just reach out to Will and myself again so we can help you with those cases. All right, again, Will, thank you, my friend, and everyone, you have a good day and take care now.
Thank you.
All right now. Bye, everybody.